the host of the Money Martyrs podcast, SMSF, investment specialist, financial advisor, small business specialist, superannuation investment specialist, Philip PJ Patterson. Philip Patterson. PJ.
Yeah, I go by PJ.
We're going to go by
I've been
PJ.
called PJ ever since the day I was born, so let's go with that.
Thank you for joining us on this one. Last minute to come in and see what you're seeing out in the space. Specifically, I had the first 2 days of the week at an alternatives conference out in the country, and gee, there's no better way to get you locked in a room and talking about alternatives and to send you out to the country and close the doors. Anything in the space that's lighting you up at the moment?
I think alternatives is a great space.
First off, thank you for joining us.
Yeah, my pleasure. Thanks for having me. And again, apologies for being a little bit late. Look, I think the alternative space is fantastic, and it's something that people should have in their portfolios. For me, I use an Australian firm for my fixed income and alternatives exposure called Palace Capital.
Ah, yes. Heard a lot about them. Yep.
Yeah, they're fantastic. I have done now for a little bit over 2 years. My clients love it. It's mainly one of those things I use in portfolios to reduce volatility, give them a good fixed income style return. It is, unfortunately, for the most part, for wholesale investors at the moment, but retail investors can access it, as far as I'm aware, on some of the platforms, which is good. But that's one thing that I absolutely love. And of course, there's all manner of ETFs and things now that are structured to provide some exposure to alternatives, and that could be options strategies, it could be commodities, it could be a whole manner of things out there. The U.S. is probably the best space for that at the moment. They're the most broad and deep market for ETFs and for alternative stuff, but Australia is catching up, which is good.
It is. And if there's one thing that I took away from this side is that the growth in credit has been phenomenal. Sorry, I'm going to, what have you?
Yeah, no, you're right. I mean, the growth in credit is astounding. I think what's happened, particularly in Australia, and it must be a worldwide phenomenon, is a lot of the banks are getting out of some of the credit space. So they don't want to lend.
Hang on. Sorry, PJ. We just lost the
Wi-Fi.
No, we just lost the Wi-Fi for a second.
It's just Heath, right?
Yeah.
Just when he...
And we are back at, sorry about that. Sorry, yes, credit, the growth in credit.
Yeah, growth in credit. So I'm not sure we dropped out there, but what I was saying is that Australia, and in particular in this credit space, I think has seen a general withdrawal by the large banks from the credit space. So they don't want to lend to, for example, land bankers, to developers, to those big construction type loans for development purposes. I think the banks got burned by that many, many years ago, and they just haven't kept the skill set up. So private credit now is one of those spaces that has grown leaps. I mean, billions and billions of dollars of private credit are being lent out now. And I think there's some very good providers of that. Now, a lot of those guys have to raise capital through private placements, through family office, through high net worths, and through institutions. So it's a great market segment to be in.
Do you think that the rise in credit has taken away? And there were speakers that were coming from remember when everything was in private equity? And sort of in that seed capital or taking companies to the next level. Do you think that the growth in credit has sucked away a lot of the enthusiasm or the allocation for that PE space?
I don't know. It may have. I think probably what's happened in PE is that there aren't a lot of really good PE opportunities at the moment, and so the money has to go somewhere. Yeah. And I think it's just found its way into private credit. It's probably part of the cycle too. Like we've been in a pretty bad or crummy economic cycle in terms of earnings growth, in terms of mergers, acquisitions, all this kind of stuff. And so I think private credit and that space has, well, probably to your point, has probably sucked a lot of capital away from PE just for those reasons.
Any other spaces that you're seeing a bit of interest in at the moment, especially in the super fund area? I think that ASIC, and I'm seeing some news about ASIC sort of going into some of those private markets that super funds are investing in. Do you see something coming out of that? I'm going to talk a little bit more about the compliance side now as we go through, because we've got our compliance.
When you say private markets, do you mean just off-market type or non-listed
stuff? Things and how?
Well, I guess, yeah, look, in that space, I think ASIC is probably, and in particular in the self-managed super fund space, they would certainly be increasing their surveillance of that because of a lot of these things that are off-market or non-listed or whatever are very difficult to price. They don't get priced every day. They sometimes don't even get priced every year. And so when it comes down to the auditing and compliance of an SMSF, auditors in particular are looking at that going, what is this thing? Where is it? How does it work? And who owns it? All this kind of thing. So tracing ownership is difficult when something's not listed on a public exchange, for example. So I suppose they would certainly be looking at that from a surveillance point of view and just checking to see what what people are holding in their SMSFs.
Well, now I've got a question for the three of us, for Heath, for you as well, and for you, PJ, being an SMSF specialist too. It has dropped out again.
Recording in progress.
All right, we are still back on. Okay, I think that worked out okay. Now here's the regulatory question, which has, yes, we are still recording. Fantastic. All right, you get those on the big jobs, you get them on the first show. Now this is the regulatory question. This is brought to you by some very good compliance experts, OCG Consulting, used to be called Oceanic Consulting Group. Now, here's a discussion that we've had, and I've had with some of my clients as well. And the question should be, if we accept that in 2025, the wholesale investor bar needs to be reconsidered, and I do believe it should be, whether it be a number or some other threshold, if we had the ear of the ministers and commissioners in ASIC, how would we construct the new test? PJ, I'm going to go you first on this one.
That's a great question. And I think that, and I've thought a little bit about this, because I actually think a wholesale investor should not have a monetary amount to it. And the reason I say that is because you could get someone who wins a lottery and gets $20 million handed to them, and all of a sudden they're a wholesale investor by the standard, but they would potentially know nothing. They could be a Garbo from Blacktown that just did that. No offense to Garbos. We do need them, of course. So I actually think it should be an education piece. It's sort of like, so you've probably guessed by now that I'm from the U.S.
Yeah.
Everyone there likes to bear arms and have guns and things like that. And most states have some requirement that in order to get a firearm, you need to go and get some training and get licensed to do that. I don't see why that wouldn't be the case with a wholesale investor. Get them to go through some sort of course. It could be a TAFE course. It could be, a number of hours of training on investing, and then get them to work with a financial advisor as well, who might specialize in wholesale type investing. That to me would be a far better outcome for clients, because frankly, I've got some very switched on clients that have $500,000 invested. I've got some not so switched on clients that have millions of dollars.
Yeah.
And so the monetary threshold to me would be ludicrous. So if any ministers are listening to this podcast, please consider an educational standard.
Heath, your views on the wholesale test and maybe what it should be tested on, as opposed to just wealth that you happen to have? Like, why, just because you're a doctor and you earn over $250,000 a year, you can be excluded from the usual protections that retail clients get?
Yeah, I think we've had a real interesting time in the U.S. The election and everything has caused a little bit of market volatility, but I would say going forward, U.S. economy looks pretty solid for the rest of this year. I think there's going to be great opportunities to invest. Hopefully, we'll see some more relief in interest rates in Australia as well, and our economy picking up. But yeah, I think the sun is shining, and make hay while the sun is shining.